It is Fed Day, and we're going to be getting commentary from the Federal Reserve here at about 2 p.m. Eastern, just after the halftime report. But we're here to kind of preview that, break down markets one step at a time in our daily show. We call that halftime report, and welcome back out to our community. We got a fun show planned for you here today. We got Coach Tyler joining us on his regular Wednesday appearance. I got a segment of Jedi Options where we're going to be talking about bull put credit spreads and using a tool we use at Tackle Trading called the Tackle Theta Research Spreadsheet. And Coach Matt's going to give you some context on how to use a very, very valuable resource called Roid, which we'll get into a little bit later when we do start to geek out in Jedi Options, digging into some of the options data. But before that, we're going to go through the markets one step at a time, looking at the technicals, talking a little bit about the news, and yes, doing that Fed preview. Let's bring the coaches in one at a time here. Matty, you first. How you doing today, sir?
Doing absolutely fantastic. Excited to be here with you and Tyler to break down the market activity on a nice little Fed Day Wednesday today.
Yeah, and Tyler, I thought you were going to show up and wake these markets up, but obviously not right in front of the Fed. How are you doing today, sir?
I'm excited to get this Fed meeting out of the way so we can move on with our lives.
There you go. Well, there's going to be another one in August. There's another one in September.
And if you're sick of the Fed, just wait till August and September with the hot takes around those two. We got Jackson Hole coming up in August, and we all know the fireworks that happens around Jackson Hole. But that's also one of the reasons why I think today is going to be a little bit of a punt from the Fed. Yeah, there's a lot of buildup and a lot of anticipation, but at the same time, nobody, including us, expects the Fed to really kind of do anything outside of add maybe a little bit of an additional commentary around the patience language or regarding the labor market, regarding the fact that the labor market has come a long ways over the last year, but there is still a long road to travel regarding the labor market getting back to pre-pandemic levels. And so the economic data from the improvements of the U.S. economy have been fairly positive. The inflationary data has been fairly concerning in the labor market, although improvement still does have a long way to go. And so the Fed has the ability to really take this to where they want to go, and the most likely destination is a conversation on patience today, leading into a much bigger conversation as we get into the Jackson Hole August type environment. So I do think there's going to be a little bit of a punt today regarding monetary policy, regarding quantitative easing and the beginning of the tapering conversation. Will they hint towards that? Perhaps. Will they add a little bit additional commentary? Most likely, especially given the fact that in March of this year, the dot plot saw 7 new members want to see interest rates increase a little faster than previously expected. Does the inflationary conversation we've been having as market participants, and does the inflationary data that we've seen in CPI reports, PPI reports, and other inflationary concerning data coming out of corporations, has that had an impact on certain Fed members and how they see interest rates in 2023 versus 2024? That's going to be fairly important here today as well. But for the most part, I do think this is a punt leading into a much bigger conversation as we approach Jackson Hole in August.
Tyler, Fed meetings in general, and let's just dive right into this, conversation, because it's the conversation in the markets here today, Matt, the Fed preview and all that kind of stuff. And if you're out there watching the show, by the way, and you're coming in for the very first time, make sure you get that subscribe, click the bell. I always got my checklist, got to remind people that are new to our channel, do that. We got a lot of new members out there, but let's talk about this Fed meeting. Tyler, you've been trading now for 16 years. You know that there's a lot of fanfare in front of these meetings. There's all this anticipation. Historically, when we started trading, there was much more volatility in the response to Fed meetings in general, but you can always get one or two, a year where they do trigger a price response. Are you approaching this, Tyler, in any different way than you approach any other day in the market? Are you hedged at all? Do you hesitate on putting new trades on? I mean, what is your tactical approach to pre-Fed meeting type of anticipation?
Yeah, a couple of things. I mean, recently these meetings have been nothing burgers, right? But like they really haven't mattered. This one, I don't know if maybe there's a little more anticipation into this one, but in regards to how I would do things different, I wouldn't have as much exposure. Like I wouldn't do anything with my core long-term positions, but I may carry fewer swing trades into this afternoon, right? Mm-hmm. So if I have positions that just aren't looking that great, I may peel them off ahead of time just to have less exposure. Am I going to run out and buy puts? No. I mean, I would rather subtract open bull positions than add new bear positions. There's just not enough setups out there to make bear trades interesting to me. So in short, peel back on short-term directional trades a little bit, make sure I'm comfortable with my exposure. Other than that, I wouldn't honestly do that much. I think one thing that's interesting is there's really not a lot of anxiety coming into this. When you look at the volatility index, the VIX, sometimes you'll get a little bit of a bid in option premiums in anticipation of an event. You're not really seeing that at all. Now the market may be wrong. Maybe they should have been more anxious, but it's just a low volatility market. And even if we sell off, I don't think it's necessarily. It could just be normal market movements. Does the blame solely lie with the Fed if we sell off a little bit? Yeah, maybe not. But honestly, Tim, I don't know that the market's given me a good reason to enter a bunch of bull trades the last couple of days anyways. It's so sleepy. Yeah. It's not as if I've been passing up really good opportunities. If it'd be a different story and a different conversation if the market had some big green bars and was breaking out and showing me really good strength. But as is, I don't know that I've been that anxious to enter a bunch of short-term bull swing trades anyways.
Matty, I'm going to ask you the same kind of question, and then we'll talk dot plot. We'll talk about the language. We'll talk about what we expect from Jerome Powell as well. You've already kind of hinted a lot as to what your expectations are, but I got a couple of the questions. What about you in terms of tactics? As a short-term trader, long-term investor, anything there, approaching a Fed meeting?
The Fed meeting today is an event on the economic calendar, and I'm approaching it with that type of mentality. Mm-hmm. I'm not putting anything additionally on the Fed today.
Yeah,
I certainly agree with Tyler that it's more the market. It's not the Fed. Like, what is the Fed going to do today to wake the market up? We don't know. That's an open question. They certainly can add commentary to the inflationary conversation. They can add commentary to the tapering conversation. They can add commentary towards the dot plot and whether or not they see interest rates increasing in 2023 or 2024. But to me, that's not a big conversation, quite frankly. I think a lot of market participants are getting to the point where we're like, yeah, raise interest rates next week. We're fine, right? Yeah. Like I think that's where a lot of people are, and I think that's where a lot of market participants are. There does seem to be a little bit different regarding interest rates in the beginning portion of this market cycle versus what we went through in 2008 through really kind of 2019. If you guys will recall, back then it was banks begging for money. It was corporations begging for money. This time around, the banks are saying, guys, we don't need your quantitative easing. We are cash heavy right now. Think about what JP Morgan said just this week. We have $500 billion that we want to activate and put into action. And so banks aren't exactly struggling for cash right now. Corporations have more cash on hand than at any point in human history. And so it's not exactly like corporations and banks right now are begging for low interest rates and are begging for easy monetary policy. I think a lot of corporations, a lot of entities out there are a little concerned about the free money environment and how long inflation is really going to last and whether or not it's transitory or not. And so I don't see a lot of market participants out there just crowing about zero interest rate policies and please give us more money. I think the market is prepared for an interest rate discussion that might lead us to increasing interest rates in 2023 versus 2024. And so even if the Fed comes out and adds commentary towards, we're a little bit concerned about inflation, and if the dot plot does suggest we're going to have an interest rate hike in 2023 versus what the anticipation was in 2024, even if that occurs, does the market really respond aggressively negative? I don't see that.
2023 is so I don't
see that.
So far away. Yeah.
Right. I think that's a hot take that I'm just not there yet. I'm like, man, if we were going to increase interest rates like in 2015, I'm good with that. If you want to do it in 2023 versus 2024, Guys, we're talking about maybe 6 quarter point increases over like a 6-year time frame. It's just not that big of a deal, quite frankly. And so I do think, yes, there's a lot of anticipation for this event. And a lot of that anticipation is simply because the Fed has not been as forthright with us market participants and as transparent with us market participants. So we're all kind of waiting for the Fed to tell us where they see things going instead of the conversations we've been having on the hypothetical scenarios. So yes, but that would not lead me to believe that this is a major event that we need to go delta neutral and wait on.
Yeah.
And so to answer the question, I'll just say this: you see a trade, take a trade.
Yeah.
I'm treating this event very technically.
Well, and even with that technical treatment of the event, because I agree with that, I don't think you can get all worked up about whatever the price response is here this afternoon, unless it was major or significant in terms of regard. Because how many times have we seen the one-day price response from the Fed meeting get reversed the next day or something like that? I'm not expecting any real clarity on some of these topics, Matt. So I don't know.
I see way too many hot takes over a less than a 1% movement on Fed day in the market.
Yeah.
So let's see this technically first. That's all I'm suggesting is let's see the market wake up first before we start building in this anticipation for the Fed.
And obviously we're going to be glued to it here as the coaches. We usually hang out after, watch that Jerome Powell press conference. That's always a fun one when he gets lobbed softball questions for an hour.
And we're going to have fun with that today.
Yeah.
But I don't want to come across as the Fed is a complete nothing burger today. It is one of those events that certainly can wake up the marketplace. All I'm suggesting is those events happening all the time. Let's see it first.
Yeah, let's see it first. All right. Speaking of seeing it first, Tyler, let's take a flash through the markets and see what the price action and the patterns are coming into this meeting. Obviously, you're on the S&P 500 here, a couple of hesitation candles. What are you seeing across all the different indexes here, Ty?
Yeah, I'm kind of tired of analyzing the S&P for the last 2 weeks because it's just noise. There's nothing here. Look, you want to freak out? We're down 0.25%. Feel free to freak out, but we've done nothing. We've done nothing. What is this? 6, 7 bars have basically gone nowhere. I don't see anything other than a stock market that's at an all-time high, chopping sideways in the summer. Maybe you could say, hey, it's the calm before the storm. It's the market pausing. They want to get this Fed meeting out of the way. Yeah, sure, I'll buy that, I guess. You just need to wait until this thing makes a move. I mean, honestly, draw a line at the low end of the range, call it 4,200, draw a line at 4,250. And if it wants to chop in the middle, fine. I wouldn't change my outlook. Long-term, still bullish. Would I be a little bit concerned if this thing rolls? Sure, a little bit, but we're still in an overall uptrend. So you got to take it a step at a time. But right now it's sleepy. And bull trades in the short run have been a little messy for the last week for me. So we just need some traction.
Yeah, it does need traction. I agree with that, specifically in certain sectors, no doubt about it. What about the other indexes here, Ty? What are you seeing?
So if you want a bright spot, I guess you point to the NASDAQ breaking out.
Ran right to 14,000 and then broke right through, Matt. So yeah, it's been a bright spot. Go ahead, Ty.
Yeah, and you've had Apple starting to come around, Amazon starting to come around. So tech is back. Am I concerned that it pulled back the last 2 days? No, I'm not. I still think it's noteworthy that it broke to a new high. So even though the S&P is sleepy, you are seeing some areas move, right? To be fair, I just think it's harder. It's because you can always fall back on, well, there's some areas that are bullish. So if you're in the right place at the right time, you made some money. Yeah, it's true, but it's harder when the S&P is going nowhere. It just makes your life harder, right? If you're in a rising tide rises all boats environment, you don't have to be as lucky or as pinpointed on the bull trades you're doing. And I feel like that's what's been required lately to make money on directional trades. You've had to be in those right spots at the right time. Otherwise, you're just kind of spinning your wheels. But yeah, I like tech. I like the awakening in some of those tech giants. And maybe this is one of the areas that leads us moving forward if we can get some upside resolution after the Fed. But I like what I'm seeing in the NASDAQ more than the S&P.
Yeah, and again, you're certainly seeing that in how we approach the sectors from a ranking perspective, as some of those growth areas have been upgraded over the last couple weeks versus some of the more defensive or cyclical areas have seen a little bit of downgrade. So we are seeing
Yep.
price response here, but when you're looking at I always find it funny, Tyler, when Tim asks somebody else to break down the S&P technically over the last few weeks. I'm like, and the whole time I had to push mute and be like, yeah, Tyler, enjoy that one. Because I've had to do it over the last few weeks. It's like, all right, let me do a deep dive on narrow neutral ranges in the S&P.
You see, Tim, this is a doji, and
And this is a doji. And if you
This is a
combine all of these dojis, we'll get, yeah, so I was laughing over here. But you are seeing and again, the S&P is flat out asleep right now, but that doesn't mean the rest of the market is. I like what I'm seeing in some of the growth areas right now. You take a look at Apple. Apple woke up out of its slumber a couple days ago, broke out of that K-trade analysis that Tyler, you and I were talking about last week with that straddle strangle analysis on earnings. This now, any K-trade scenario, once it breaks out, you're looking at price appreciation here. And over the last 2 days on Apple, that no sell day, it's held its ranges up towards the high price. You gotta like Apple's potential here. But you're also looking at Microsoft, two of the biggest components in how we categorize technology. Obviously, Microsoft more so than Apple, being the consumer-dependent company that it is. But you're talking about Microsoft up against its all-time highs. That Microsoft has just found some broken out of resistance. Now it's starting to consolidate at the all-time high. You could really start seeing something line up above that 260 level. Give you, and I know you guys have heard this many times, give me another couple days consolidation on Microsoft and line that 260 breakout really, really, really well. You got to like what you're seeing there. We talked about Taiwan Semiconductor the other day and last week. Taiwan Semiconductor, the biggest technology component in semiconductors. It is a massive company and a fundamental darling to the marketplace. Obviously, with a lot of geopolitical situations in recent history, and with the problems from a growth perspective in general, Taiwan's been out of favor. But you know what? That double bottom was very clean, reclaiming the moving averages, very clean. Snapback coming into those moving averages, held its support channel. And so you're starting to see Taiwan wake up a little bit. And then when you look at the other semiconductor companies like NVIDIA, who doesn't like that breakout of 700 that NVIDIA just did with a consolidation above that level? And so, yes, you are. And I could go down the list at some of these tech companies waking up. But the reality is we are seeing that from a sector perspective, and we are seeing stocks that have shown weakness at resistance, like Apple, like Microsoft, like Taiwan Semiconductor. We're seeing those stocks reclaim resistance, showing a little bit of from a price appreciation perspective. And so, yeah, I do have concerns that the market is asleep right now, and it could maintain that sleepy nature over the course of the foreseeable future. But that does not mean everything in the market is boring. It's a stock pickers market, and it has been for the last year, guys. It's been a stock pickers market, and it's going to continue to be a stock pickers market. And those individuals that are really at the forefront of sector rotation models, like we're seeing right now from cyclical and safety back into growth, those individuals will be paid handsomely, in my opinion.
Stock pickers market is exactly how it's been for the last year, like you talked about, and we've had a rotation here, there, and the rest. And it's great to highlight some of these tech charts because there is some interesting patterns out there developing. That Taiwan Semiconductor one really is on my radar specifically. I really like that one developing for a potential breakout. Anything to add to all this, Ty?
No, I just like with the growth waking up, like biotech had a nice little breakout here as well. But then you're just not getting substantial follow through, I guess, right? Like I like it, but I want more, right? Like it's testing your patience on breakouts, and even at TSM, it's shaping up, but if I bought the breakout 2 days ago, now I'm like, hey man, come on, let's do something. So I feel like that is a byproduct of the general market just being a little too sleepy, to where, yeah, there have been some areas that have been stronger, but
Do you
you've
think,
had
just a quick question on your point there, Ty, do you think some of this like the snapback on Taiwan, for example, and the hesitation on Apple after a breakout, and then obviously the hesitation towards the all-time high on Microsoft, just taking a look at the charts that we just looked at, right?
yeah.
Do you think some of that has to do with the NASDAQ being slightly overextended coming into that all-time high breakout?
I mean, it certainly could be. Yeah, I wouldn't argue that. I mean, it has run up a fair bit. It yeah. So yes, sure. I would be okay with that rationale.
And that's just, again, just adding a little perspective. The NASDAQ is slightly overextended coming into that breakout. Right. You are seeing a little bit of hesitation the last 2 days in those growth areas. Like Taiwan had a wonderful trigger 2 days ago.
It did.
Apple had a wonderful trigger 2 days ago. And I certainly respect your point. Where's the follow through there? Right? Yep. Like you typically see follow through on companies like Taiwan and Apple when they break out like that. Where's the follow through? Well, the NASDAQ just hit its head against a major resistance level called 14,000.
Right.
The market is a little bit, and again, I don't want to add added emphasis on the event today, but you're talking about a market that is slightly overextended coming into a technical level that is very, very important right in the face of a Fed meeting. Yeah. I understand the last 2 days of consolidation is all I'm saying, which means I also understand the lack of appreciation from a price perspective in Apple and Taiwan specifically. Yeah. It doesn't change my overall view that those breakouts were legitimate.
Agreed. Yeah.
Correct. Yeah. And it does make sense in terms of the sleepy response to them, though, because we are pre-Fed and the NASDAQ was overextended up near that resistance.
And again, I'm not saying the NASDAQ is overextended historically. I'm just saying slightly overextended
in the short term.
We come into resistance in the short term is all.
Quick look at the Russell, if you can. Ty, you're here. We got to look at small caps at least for a moment. I know the Dow is just on a little bit of a deeper pullback. You can glance at that if you'd like to. But this rut, I think, is actually playing pretty good defense after the breakout last week, Matt. Kind of holding that old breakout channel, getting ready for potentially just this consolidation until we get a new breakout up at 2366. I still like it. But Ty, what are you seeing? I mean, that's 3 out of 5 little red dojis, and kind of bringing it back down. What are you seeing here?
Yeah, well, again, like this I think is just the next piece of evidence of a market that's it's okay. I just want more. I just disappointed, like I'm giving the kid a talking to. I'm like, you could have been so good here. But yeah, it had a great breakout, and then it's like, nah, screw it. I'll just make you wait for a couple of weeks.
I'm 100% with Tyler on the I want more perspective. But you still gotta like the fact, and okay, I feel like a broken record at this point because all I ever do is talk about the defensive nature of the market, and what Tyler's wanting is the offensive nature of the market.
Indeed.
And I think Tyler is speaking the exact same thing I do too, because it's like, guys, we've played this song and dance routine for a little bit now. What Tyler's really saying is, are you going to go or not?
Yeah.
Right? Are you going to legitimately go here, or are you just going to lull us to sleep again and come right underneath that 2300 level, reset all the technical triggers? Are we going to repeat this yet again? And so I totally understand that, because again, the only thing we've been talking about as traders in the broad market conversation, not against sectors or industries or individual stocks, but from a broad market commentary perspective, is defense, right? You like the defensive nature of support. You like it playing defense above 2,300. And it's like, okay. At some point, you got to score.
You got to play offense as well. You got to put some points on the board.
So I'm 100% on board with Tyler, because, man, this is now 3 weeks the market's been asleep. Yeah, the NASDAQ's waking up, the Russell's waking up, but we still haven't achieved all-time high breakouts yet.
It's true.
All you've done is done recovery analysis so far.
You could have been great, Russell. You
You
could have been a
still can.
contender.
Wait, no, you still can.
You guys still got to
still
give him the
can.
Rocky talk. Yeah.
Yeah,
No,
but it's not
today.
dead.
No, it's just sleepy and it's
Yeah,
playing
it's just
defense.
sleepy.
Needs to get the ball back, Ty. It needs to get the ball back, start pushing higher for us to get too excited about that one. And then I don't see anything in the Dow that we need to highlight too far, but if you want to take a flash at it, you can. We're going to move right into commodities next. He does not. I like that answer, by the way, because nothing really in the Dow we need to go to. Let's go through the commodity market next, though. Crude oil, just an extension of this overall trend, had a larger than expected draw out of crude oil inventories today. Didn't even move the needle within a very, very tight range here on the intraday. Anticipation in front of the Fed. Obviously, inflationary conversation is going to impact all commodities, but crude's just had an incredible run here. Ty, what's your read on crude's chart?
Yeah, it's so incredible. In fact, I saw the stat today. This is a record for the number of consecutive sessions that crude oil has made an intraday high, like higher than the prior day.
Really?
Today is the 14th day in a row that crude oil's made a higher high, consecutively day to day, which essentially means it has never been this. Which, granted, market does new things all the time, right? So take this with a grain of salt. But what is unique about this particular ascent is it is very uncommon for 14 consecutive days, which is almost like 3 straight calendar weeks, right?
Yeah.
Just marching higher, higher, high, higher, high, higher, 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 high. Even though it didn't close above the prior day, intraday, it kept going higher. So uncanny consistency here out of oil on this run. I saw that stat yesterday. It was 13 days. Today's the 14th day. I mean, it's bound to end here sooner than later. It's just, when you do something that rare, I don't think it's going to continue that much. But it just speaks to how impressive oil has been when everything else has been just kind of dull.
Well, and honestly, what analysis do you want that leads to price appreciation here for crude? Do you want the inflationary conversation? Do you want the decreasing supply, or do you want the increasing demand?
That's the one that matters to me.
Because all three of them are bullish for crude.
But the demand increase is apparent out there. We've seen inventory and numbers obviously draw in the past. They don't always move the market, but the demand implications, as well as the inflationary conversation, all of them lead to bullish crude price action. In 14 days in a row, Tyler, I know it's just like paper cut bleeding its way up the chart. It's not like these are huge candles, but that is an impressive statistic.
Well, and quite frankly, the only thing bearish we're talking about with crude is the hypothetical response to OPEC in July regarding increases in barrel production.
Yeah.
Which, quite frankly, if I was OPEC, I'm opening it up a little.
I'd sell more product. I got higher prices. Come on. Economics.
I got higher prices and I got
right.
increasing demand.
Yeah, need the revenue. Let's go.
Which that certainly could stall this crude projection, but it doesn't hurt energy in any capacity.
No, that doesn't hurt the energy companies at all, because profitability at $72 is definitely going to be there. In fact, I think if you continue to see this, you're going to see some dividend increases in that sector.
Oh, ExxonMobil executives are high-fiving themselves. Yes, they're happy.
Absolutely.
Well, and how good do you have to feel that you didn't cut the dividend last year and you stuck by your guns, and then you're getting bailed out here, right? Yeah. Good call.
Mm-hmm.
Yep.
Absolutely. Gold next here. Let's keep moving through the market. Take a look at the metals market next. And obviously, weekly, daily analysis is what we've been doing for a couple of days here, Tyler. Essentially, short term, the daily is kind of a little bit more messy than it was, obviously, over the last few weeks. We need some time there. Still like the developing trend on the weekly at 1850 is a key line in the sand. And you've got that line right on your chart as well. What's your read here on gold, Tyler, technically?
Listen, it disrespected my trend line, so I'll extend my disappointment to gold too. You would have preferred to see an upside resolution out of this little triangle pattern. It resolved itself downward, which, I don't know, for me, I kind of take off the trend line at that point, and it looks more neutral now, right? So short, now intermediate term still bullish, of course, still above a rising 50, but yeah, short term has neutralized a bit. Probably don't want to see this take out 1850. I mean, that's old support. You take out 1850 and you're kind of in a short-term downtrend at that point. So will be interesting to see what the resolution is with the support test. You'll likely get a little more movement after the Fed meeting, I think, but a little cautious under 1850 in the short run for me. Not really a trade setup either. Like as a short-term trader, what's the play in gold? I don't know that there is one, quite honestly. This is less compelling than it used to be over the prior couple of months. So I don't know. I'm just kind of waiting for resolution on this support test.
Yeah. Matt, what about you on the support test here?
I'm with Tyler. Once you violated the trend line, and Tyler, I'm glad to see it took you about the same amount of time for him to erase that trend line today.
Yep.
Like I wanted to see it for another couple days. That's all, right? But no, I'm with Tyler technically here. There's not really been a new entry in gold for quite some time from a short term perspective, and with the violation of the trend line and the increasing volatility and choppiness as it approached 1900, I think you got to be slightly concerned. But overall, I still think the gold analysis is fairly healthy. It needs to hold support. And when you talk about the market response to the Fed, the first response is always going to be to the currency market, the second response to the commodity market, and the third response is to the stock market. So you certainly could see some price movement here in the gold market. It really depends on what they say regarding everything today, because the dollar will be sensitive to that. We know gold is sensitive when the dollar is, and so it's going to be a little interesting on that support test today. But overall, I certainly agree with Tyler that it probably needs some time. 1850 holding is important. The reason 1850 holding is important is the weekly chart. If that does not hold, you're talking about a short-term downtrend, and you're looking at maybe lower prices, maybe even into the 1800 level.
Key test there. We're going to be watching that chart as it develops.
The weekly chart looks beautiful. Right now.
Does.
I agree.
It looks beautiful right now. And the only thing it needs is more time, but that more time also includes 1850 holding.
Yeah. Good. Speaking of the dollar, there's not much in that chart to update. If you want to take a look at UUP, it is flat in front of this. It can get the biggest impact from Fed meetings, though, like you mentioned, Matt. So watching dollar volatility after the report is something we're going to be doing as well. A little doji in front of the meeting, though, like many of the markets. Matt, anything you want to add to the dollar here?
I very rarely want to add commentary to the dollar.
Bitcoin last, and then we're going to get in a few stock talks. Then we're going to have a round of Jedi options, and Tyler's going to be doing some teaching around the bull put spread, and we're going to talk about that just in a few minutes, highlighting the concept roid, and I'm excited for that Jedi options segment. Bitcoin hesitating at that 41K level. It's still, fighting against that resistance, Tyler. It had a nice little rebound off the 200, but a reminder, we're not out of the woods yet, obviously, and we've been talking about that for a while. What you read here on the chart?
Yeah, I think what you want to see is you don't want to see this go back and revisit, 30K or 34K. I think any kind of backing and filling up here would be ideal, right? To be fair, this ran from 30,000 to 40,000 in like 5 days. So can you be mad at it for chilling out a little bit after such a big run? Probably not. But I will be mad at it if it goes all the way back down to 30K, right? So show me that this rally is different than its predecessors. And the way you do that is you don't puke up all the gains, right? Like you want to back and fill, fine, but do so in the upper half of the range to show me that there's an increasing demand, that buyers are stepping up quicker. They're not letting it go all the way back down to 30K. That would be ideal. May not happen, but that's what I'd like to see. And then I think that sets up a nice little breakout trade over 41K.
Wouldn't you like it a little bit better if it did fill that gap over the weekend and show an increase in support right around the 20-day moving average?
Yeah,
I think you would like it more.
Sure. Yeah. And it would take that off the table where you're like, is it going to fill the gap? All right, we'll fill the gap, become support.
Yeah, exactly.
And then that's off the table. Yes. Agreed.
Yep. All right. That's it from market skyline perspective then. And I'm watching this one as well, obviously, just from a longer term perspective. I just want to see the thing kind of consolidate and hold for a while. The trading mechanics, by the way, is what you guys are talking about. I still think there's a potential trade above 41K, Matt, if it can do it with some steam. But we'll keep watching Bitcoin. There's not much there to add for today. But a couple of the quick corporate stories I do want to get to. There was one company in the earnings news today that I thought grabbed my attention, Oracle. Let's start right there. And Matt, I don't know if you had a chance to dig into the numbers, but what did you see from Oracle's earnings report?
Oracle comes out and a little bit of a mixed bag here on Oracle. Oracle reports EPS numbers of 154 versus the expectation of 132. Revenue came in slightly above the expectation at 11.2 billion versus the expectation of 11.1. That resulted in a year-over-year revenue increase by 7.5%. All of those are fairly lukewarm type numbers when you're talking about a company like Oracle. But the problem here, and again, passable numbers on the raw numbers, nothing to really kind of, you know, brag about, but passable numbers. The problem is guidance here. Oracle lowered EPS guidance by about 10%. Price response was to the negative.
Mm-hmm. You know, Tyler, when you see a gap down like this from Oracle or, big company, this had a really, really good trend developing, but now we've gapped below the 50. Yes, there are some old historical supports there, and a lot of times that gap will settle in and kind of backfill a little bit. But do you have any take on how you approach this?
Yeah, a couple of things. I mean, first off, you can't run from 60 to almost 90 and then be like, yeah, our earnings aren't going to be as good, right? It's like, no, we jacked your stock price up a bunch. You better deliver. This is where you talk about, and I don't know what the multiple was, but high multiple stocks, frothy stocks, those have been bid up a lot. If they're priced for perfection and then they disappoint, this is often what you'll see, right? A quick haircut. In terms of how I would trade it, look, sometimes, I mean, look at what happened last time, actually. This is a good case study. Sometimes they come right back, right? Sometimes they come right back. But even then, it's still based for a couple of weeks, gave you a nice little potential gap fill / breakout trade. I don't know that I want to be the first one in the pool after that kind of drop, right?
Mm-hmm.
And so maybe use this as kind of your analog or your comparison, and I want something similar. Let it back and fill. I don't want to be the first one in after the down move, because even though like the prior episode was bought relatively quickly, other times that earnings miss will hang over the stock for the entire quarter, and it won't be until the next earnings announcement where they redeem themselves that it recovers, which essentially tells you that the odds are just not in your favor to buy on the first down day. So be patient, wait for a better setup, and then we'll see.
I agree. I agree. A couple other companies grabbed my attention in the news today. Roblox, which is that popular IPO that came out earlier this year. Obviously, it's been trading now for just several months, and one of Coach Mark's favorites actually broke out after their post-earnings report. They had real strong numbers in terms of their active users. They came out and said that those active users actually slid in May. And Matt, it wasn't that big of a number actually. I believe they only slid like 300,000 daily active users. But when it's a growth company, you want to see numbers going up, and that didn't happen here today. Stock gap down into old resistance as new support. Do you guys have any interest in this pattern developing? We are post earnings here for the first time on this chart, and you have some technical history here that does suggest this could be a support. Matt, what about you here? Are you interested in Roblox at all?
Yeah, it's really the first test of that 50-day moving average, which coincides with an old breakout channel right there around that significant whole number of 80, and it stopped on a dime there. It stopped on a dime on the intraday, and so yeah, it hasn't confirmed that as a support. This is the first test, but when you're talking about the potential support catalyst, previous resistance levels, significant whole numbers, moving averages, and yes, Tim, I'll bring up the Fibonacci retracement here as well. You're in that zone, right, of what could be major support because it coincides with so many different hypothetical catalysts that do behave as support as from a technical perspective. And so, yeah, I do like the zone that Roblox is in. From a directional perspective, I do think you need to see a little bit of slowing momentum here. I do think you need to see a little bit of a potential reversal on the intraday as well. So it needs a little bit more time, but you are absolutely in that zone and you're absolutely on that price point that analysis starts to that where you really start to look at that type of analysis. And so, yeah, I do like Roblox, the company. I do like Roblox from a growth perspective. I think you have a little bit of an overreaction to a very minor adjustment on their numbers, but that's the environment we live in. Markets asleep, we're going to overreact to any degree of news in the individual components of that market. And so I think this was a little bit of an overreaction. like the support level. It's building at $80. Need to see that confirmed specifically from a directional perspective. But yeah, I do have interest there.
Yeah, I have interest as well. And for the first time in a while, you know me, Matt. I think you probably share this same rule. I don't trade before the first earnings report, on an IPO. So I was waiting
Not
for that
even
data to come
on
out,
a company like Roblox we love.
which I love.
Yep.
Yeah, absolutely love. For a year and a half, I've been waiting for Roblox potential trade setups and all that kind of thing. Starting to finally get some patterns and some price action that I'm interested in. So
honestly, the first potential trigger from a technical perspective is typically once you start getting moving averages, you typically start to get a little bit of trend and pattern analysis, and that just takes a little bit of time. And so following an IPO, we like to see at least a quarter. Right? We like to see those moving averages. We like to see how the market is going to respond at certain price points. And now that when you broke out of $80 post earnings, about the week and a half post earnings, that was really your first technical trigger for a potential trade. You then clearly established another level of higher high at $100, slowing momentum at that $100 range. Saw a little bit of a dip down to 80 here. So yeah, I do think you gotta like the position you're in. This is the first major test in a pullback for Roblox. If it passes, I think it's going to be really good.
And here's a story that we've actually given at least 2 times in the last 6 months that I can remember. It might happen 2 more times in the next 6 months as well. General Motors, adding to their anticipated spending around electrical vehicle production. Matt, they just increase their projected amount they're going to spend. Now they're increasing another 30% to a total of $35 billion through 2025. And they announced they're going to have 2 additional new battery plants that are going to produce those EV batteries. GM, this is the storyline around this company as they're trying to transform it, and obviously a little retracement here. Tyler, is there anything in the chart that grabs your attention? Because I see some interest in an old resistance, new support test, but we had an old pivot point. It's kind of a mess in general as well. What do you see here?
Yeah, we'll take the chart first, then I got a fundamental comment. I see a gap up that got stuffed. I mean, this had a really good pattern coming into today. This was textbook, actually. I mean, it was a delightful little bull retracement. Tested the 20 MA, test of old resistance, new support. Love the pattern. Then you get robbed of the ideal entry, right? It gaps up, and if you want to buy it, you got to chase it. Tough move, man. Down all day long. It's at the low of the day. Really throws a wrench into what could have been a clean trigger. So I do not like the response whatsoever.
Mm-hmm. Yeah, the way the candle's shaping up, it kind of throws that trigger off a little bit. Matt, any interest in GM here?
No, not really. But I'm kind of getting sick of people trying to attach themselves to the E and ESG.
You're going to see a lot of it, brother.
Come on, GM. You do it like every other week.
Every 2 weeks.
We're good.
Now. I know, it's the same story over and over again.
We get a GM. You want to go EV. You want that Tesla investor money. We all get it. You don't need to say it every day.
Yeah. I've got a new image, guys. All right, go ahead, Ty.
Yeah, well, I have a comment on that. I mean, okay, so if fundamentals actually matter, do you think you're going to sell more cars? Is the profit margin better on an electric vehicle versus an old one? I don't get it, dude.
I don't think these moves are going to project short-term profits. And when I say short-term, I mean like 5-7 years worth of short-term type of profitability. I think a lot of this movement is because they see the future 10, 15, 20 years down the road.
They want Larry Fink's money.
And that's a big part of it as well. Yep.
So do all automobile companies just permanently trade at higher valuations going forward now because because EV has this psychological thing around it that justifies higher, even though it doesn't translate into better profits.
That usually happens until the crash occurs, and then we get back to some degree of reality.
Yeah.
No, there's a bubble happening a little bit in EV, guys.
Mm-hmm.
Like this space is extremely crowded right now, and it's a big space, and it has plenty of ability to have multiple successful companies in it. I'm not suggesting that. But it is an extremely crowded space with people begging for Larry Fink's money from the ESG perspective.
Well, that's the thing, is it's not really a differentiator. It's not a differentiator anymore. Yeah.
It's just not.
Remember that old show, Win Ben Stein's Money?
Now it's Win Larry Fink's Money.
Win Larry Fink's money. That's
Like,
exactly right.
I just want I want all the EV CEOs to get on Win Larry Fink's Money, and let's create a game show about it.
I think it would be funny. We could do a parody.
We'll put it
about
on Tackle Trading's YouTube channel. Let's do this.
We'd get Jamie Dimon. We'd get all kinds of different executives. So we get
could.
Elon Musk. Yeah.
We could just go Saturday Night Live parody type
Of course.
game
No,
show.
that's the angle we're going for.
And I play Larry Fink.
I'll play the late
You're
great
playing
Alec
Elon.
Trebek role. No. I'm the host. I get to ask the questions. Tyler gets to play Elon. That's the way we're
Okay,
gonna do
I
it.
could see that.
All right. Anyway,
right.
that's all I've got in the news here today, guys. Let's move right into our last segment, and one that I have a lot of fun with, Tyler. I got to tell you, these are the conversations that you and I and Matt have had privately and in other coaching meetings, just externally outside of webinars and whatnot for 15, 16 years around the options market, around implied volatility, around the best way to build a certain spread trade or whatever it might be. And we're calling this segment Jedi Options, where Coach Tyler gets to take his expertise, his experience in the options market, dive into a topic around it, whatever it may be on that week, depending on what's happening in the markets, kind of deep dive on it and really geek out with option math. So Tyler, what you got here today and what are we setting up?
Yeah, so today we're going to illustrate how to use one of the tools that we provide at tackletrading.com, the Tackle Trading, the Theta Research spreadsheet. So for those that are pro members, you get access to these. Tim, I'll pull up the website here real quick. So under the Trade Center, under journals, that's where you can download the journals. And there's some videos that we put together that explain how to use it. But I compare option strategies. I usually bring a couple option picks. I wanted to just make this a little bit more robust conversation and use the journal to help kind of pitch how I would build bull put spreads in particular.
I think it's fantastic. And if you scroll down just one hair here, I do want to highlight something. There's 3 different journals. And the one we're going to be highlighting today, the trade journal, is where you log your trades, your gains, your losses. You can keep an equity curve over time. The Theta Research tool, and you've clicked that tab right there, Tyler. This is where you can download that tool. If you are a pro member, it's included in your pro membership at Tackle Trading. Make sure you're logged in. You go to the events page, you can find it right here. And there's a download button just underneath it. And, one thing as we get started here, I love using this as a visual way to educate and to teach people. There's no question about that. It's a significant value for any option trader to download this and understand it. And Matt, many years as I've been coaching people or working with them one-on-one, we spend a lot of time in this research journal. And I know that you've spent a lot of time in here. And in fact, you're the one who came up with the concept ROID, which Coach Tyler is going to highlight here in just a minute. Anyway, I'm glad you brought up the events page there. Matt, as we set up the conversation though, just what do you think about the importance of ROID, and kind of explain that just a little bit if you can?
Well, first and foremost, ROID is just a simple indicator that we use at Tackle Trading to determine whether or not a credit received is actually a legitimate credit from a cash flow perspective. And when ROID was created, it was created I first started teaching ROID about 10 years ago, but I legitimately started putting it out there in 2013 and 2014. But when I first learned how to do credit spreads, and Tyler, if you'll go to an option chain, any option chain, when I first learned how to do credit spreads, basically the general philosophy was, if you're selling a credit and you're getting about 10% against the margin required, you got a good credit, right? And that always just didn't. I don't know about you guys, and I'm talking to the entire community, but have you ever had a moment where somebody taught you something and you immediately started thinking, it's got to be more in depth than that? Mm-hmm. It can't just be that. Because when you compare A against A without comparing it against something else, how do you know if it's good or not, quite frankly? And that's just the way my analytical mindset works, is I always do cross comparisons. And so when I first learned how to do a bull put spread, basically what I was taught was, if we sell around a 0.20 delta, which is a 20 delta, and we get a minimum standard of 10% of the return, that's a good credit. Well, after I started doing a lot of credit trades, a lot of bull puts, a lot of bear calls, over time, I started seeing that not all 10% credits are created equal, right? And sometimes you have to deal with volatility, and sometimes you have to deal with ranges, and sometimes you have to deal with other things in credit trading as well. And so I started doing some research regarding, okay, if I sell 10s, 12s, 15s, 18s, 20, 25, 30, 1 deltas, right? I started doing a whole bunch of just research regarding, if we sold this delta versus this volatility, where is that zone that we really want to be in? And what I had found is that the 10% of credit was random, was purely random. And what it was really about was comparing the delta against the credit received, which was important. And yeah, 10% could be good if you were selling a 10 or a 12 delta. But if you were selling a 20 delta to get that 10%, it just, in my mind, it just didn't, it wasn't good enough. And so I started doing analysis of taking deltas versus cash flow received on different time frames, and started studying this over time to find out where those zones were. Where is the zone on Royd that we're looking for? For example, if you got if you're selling a 20 delta contract and you're getting 10% of the spread, that would be a 50 Royd, because you take delta and you divide it by ROI is what you do to establish the Royd. Now, without the historical metrics of what is good versus bad, again, Royd's just an indicator. A 50 Royd without a comparison doesn't make sense either. What you're looking for is those historical zones on Royd to really establish a good credit. And so if you'll go to the spreadsheet, for example, there's a couple key things that I'd like to point out to the community. Number one, the spreadsheet was designed so that you just have to fill out the data. So you take the data that you need based on the systems, and if you'll scroll down just a little bit here, Tyler, you'll kind of see some metrics of what we like to look at, from delta sold, time frames, what you really are kind of targeting from a Royd perspective. So there is some metrics there as well. But if you'll scroll back up, what we do is when we're looking for a credit, we might actually fill out 10 to 15 different potential credits just to cross compare to find the two that are really good. Again, trader one that is new to the market, they see a credit, they sell a credit. Real traders do research. Real traders do cross comparisons to find that zone. And so what you want to do in the Theta research spreadsheet is you simply identify the stocks you want to research, the different time frames that you want to research, and then you just start filling out data. That's all you do. You fill out the price, you fill out the ATR. The month, I never fill out the month. It's just for people visually when I'm teaching them, but you just fill out the month. The DTE is the important point in the metric, though. DTE stands for days till expiration. So I might be selling a July option, but I might be cross comparing that against a weekly July option, which means the month to me is not important, but the 30 days or 37 days or 44 days is important to me. And so DTE stands for days till expiration. You just put that in. And so today we got, what's the July expiration, 30 days from now?
30. Yeah.
Okay. So it'd just be 30 days on the monthly, right? Short option strike is the strike price on the delta we're selling. Short option delta, you fill it out with a fraction. If it says 16, you write in 0.16. Long option strike is the strike price you're buying to create the spread. ATR buffer is something that is automatically given. So once again, when you take your price and you take the ATR, what the ATR buffer is the total amount of ATRs that you are selling the strike price versus what the current stock price is. And if you'll hover very quickly, Tyler, above ATR buffer, you'll see a little bit of a drop down that what we want to see here is a minimum of 2. And so when we're selling a 30-day option, you have to be getting at least two ATR ranges. And the reason that is important for me is if you're getting less than 2 ATR on the strike price to the stock price, that's your range you're selling before your credit is in danger. If you're less than 2 ATRs, personally, I would rather treat that as a directional opportunity because you are not getting the range necessary to justify the risk. Remember, in a credit spread, guys, you can always lose more money than you can make. ATR ranges is your buffer. That is, and if a stock goes down, that's not necessarily a negative. It's if the stock goes underneath the strike sold. And so having the range necessary on a credit spread is very important. Less than 2, that's a deal breaker for me. Less than 2, either 1, it's not a good credit trade because of volatility, or 2, it's not a good credit trade because the better trade is most likely on the directional side of the equation. And so it's one of those telltale signs, and you'll see as we fill it out, if we do have an ATR under 2, it'll fill it out red. If you scroll over to the right a little bit, the net credit is the credit you are receiving on the sell of the spread. BPE stands for buying power effect. Now, this is a debate that many traders have had internally and with other traders. When you calculate your ROI, do you take the margin required or do you take the difference in the spread? What we do in the spreadsheet, according to Royd, is we take the difference in the margin. And so if you're selling a 5-point spread, we don't type in $500. We type in what is the actual buying power effect. And so if you receive 50 cents on the credit and you have a $5 spread, the buying power on that is going to be $450. So you take the 5 minus the 50, that's $450. Tyler will show you how to do that in your Thinkorswim software. It's done automatically for you. I just wanted to add the context to it. And then the alert, and what I like about the alert is it's based on 1/2 the ATR above strike sold when you're doing a bull put. So for researching bull put spreads, and we've identified 3 or 4 good candidates, what I like to do after the trade is put on is I want to set an alert above the strike we're selling. I want to be alerted to a potential risky situation where I may need to do some trade adjustments or we may need to make some trading decisions. Remember, where the risk is in a bull put spread or any credit spread, it's not when it's above the strike price. That's the zone that you're in. You're good. It's when the strike price is hit and it goes underneath the strike price. We want to be alerted before that occurs. And so we put an alert 1/2 ATR above the strike is sold so that we know that we're in that risky situation and we need to be more aware of what is happening. So the alert is just simply 1/2 ATR above the strike that is sold. So that is the indication where you need to put an alert to have trade management discussions. I just wanted to take a moment to kind of explain the spreadsheet.
I think that really helps. It helps set up what we're going to be doing next here, Tyler, because now you're going to be filling out a few of these here in the spreadsheet. And I got to tell everybody out there, if you are a pro member and you don't have a copy of this, I've been doing this for a long time. Grab one of these copies, start playing around with it. Use the tutorial here from Tyler, get an idea on how to fill them out. But I would fill an entire one out. Look at different spreads within the same stock, all that kind of stuff. So Tyler, let's see how it works. Kind of walk us through this if you can.
Yeah. So Roblox is a stock we talked about earlier today, and I think it's got an interesting setup for a credit spread. So I'm going to compare 2 credit spreads on Roblox, one with a little bit higher delta, one with a little bit lower delta, and then we're going to compare that to maybe a couple other ticker symbols and see what the difference in returns look like versus the volatility of the stocks, and you'll start to get some interesting takeaways here. So Roblox, I'm in my trade tab in Thinkorswim. The stock price is 82.65. And I'm going to do this twice, so I'll throw both in there. The average true range, I find that on my chart. I have a little indicator that tells me what the ATR is, $6.34. That's essentially how much this is moving on average per day. It's a little high right now because of the recent volatility in the stock. Obviously, if an $82 stock's moving $6 a day, that's a big percentage move, right? I suspect that number will come down over time. We're going to be using the July monthly options. This part's not super important, as Matt said, but I'm going to put the July in there. days to expiration. So when I look at my option chain back on the trade tab, the days to expiration is this number in parentheses. So right now, it's actually a pretty good time to illustrate this because the math is easy. We are exactly 30 days from next month's expiration on the monthly. So 30 days is the DTE.
And Tyler, can I take just a quick moment to explain something that is fairly important here? If you widen the spreadsheet out a little bit, what the spreadsheet does on the key metrics is it always reverts to a standard 30-day number, because sometimes we'll sell 35 days, sometimes 42 days, sometimes 23 days. And so what the standard ROI does, the ROI in the performance metrics is just based on whatever the like credit received, 48 days, whatever it is. Yep. But what I like to do is standardize everything to that 30-day number, which will help me visually adjust to different time frames.
Yeah, and the implication there is if I get a 5% return on a 30-day trade, and I'm comparing that to a 5% return on a 10-day trade, it's not apples to apples, right?
No, it's not. It's not, and we'll kind of look at that as the metrics get laid out here.
Yeah. Mm-hmm. So with Roblox, I'm going to go to July, and I generally want to sell a bull put with a delta less than 20 or so. So the first one I want to illustrate is the 16 delta, which is the 70 strike price. I'm going to sell that, and I'm going to buy the 65. So we've got a $5 wide vertical spread where the short option is a 16 delta. So short option strike is 70, delta 16, long option strike is 65. The net credit is 77 cents. Well, 75 now. Go 75. Now, I can do the BPE in my head just because I've done it a million times, but if you don't know what the buying power effect is, you can go to confirm and send, and in the preview box, it'll tell you right here, buying power effect, $425, which is just the $5 spread minus 75 cents. All right, so 425 is the BPE. Mm-hmm. So now I've got some information, right? I've got some information here. And did I, let's see.
Change your,
am I off on one of these?
Yeah, change your credit.
Oh, that's why.
Yeah.
There we go. All right, so net credit's a whole number. Actually, it could be 0.75, but then you got to do per
if you change the other one, yeah.
You just got to be consistent. I'm with you. Okay, so $75 credit, $425 BPE. There we go. Now it looks right. Okay, so the return on investment is a 17.6% return. The reason that's the exact same as the standard ROI is because both of them are 30 days, right? If this was a 25-day time frame, the standard ROI would be.
In fact, just change it to 25 just to illustrate it.
Yeah, because if I'm making 17% in 25 days, if you do that on a 30-day basis, it'd actually be more over 30 days. Right? In other words, it's better to make 17% in 25 days than it is to make it in 30 days. Yeah. So, okay, couple comments, Matt, and then you can mention anything that I didn't mention here. But so 17.6% is a good ROI for a credit spread in general, right? That 10% number as kind of the ideal ROI target, 10%, we're obviously exceeding that. Yes. But the question is, what is the likelihood I'm going to get to 17%?
This is, I love this conversation because everybody and their dog went to that 17.6%.
Yep.
Everybody did. And yet that number was very irrelevant to me. The number that was important to me was the standardized ROID in comparison to the standard ATR buffer. What that ROID is telling me is I am getting a significant return for the delta we are selling. That is what it's telling me. Anything above 100% is ridiculous on the credit. With the ATR at 2, you're at a minimum standard there. What this tells me is that this is a decent trade. The ROI, people would say this is a great trade. I don't think so. I think this is a very mediocre trade because you do not have the range necessary to justify the volatility scale on Roblox. And while I certainly do agree that Roblox has had some news in recent history and that ATR could contract, Roblox is an aggressive growth company that it will always trade at a higher ATR than others, right?
Yep.
And so that could happen, but right now we know what is happening with the volatility. And so what this tells me is that I need to give up a little bit of, if I like the Roblox technical situation, I need to look at giving up some of that potential return to get more ATR ranges. I have enough volatility that I could be conservative here, is what I'm suggesting. And so what I would do is I would say, okay, I'm selling a 16 delta, which is perfectly fine for a bull put spread. Nothing wrong with that. I'm just not getting the range necessary to justify this type of risk. In my opinion, 2 is a minimum standard. Other people could take it. But I would like to see a lower delta on the same time frame to see if if the numbers still make sense with the credit where it needs to be, but now I'm getting a little bit more range. Guys, ranges to me are probably even more important than the ROI is to me on a credit.
Mm-hmm.
Yeah.
Guys, I don't want to manage credit trades.
Well, sure, because even if you get this huge credit and you get this big ROI and it's smashing you in the face, like that's exciting. If the volatility is too close to where your cushion is, if you don't have the distance you need, the management degree.
If I have to manage a credit spread, it's because technically it violated a lot of things.
That's right. Yep.
And so technically there's just concern there. So what I would like to see, and again, it's based on the fact that we have a much more than the 80% in ROID. And if you go to standard ROID, just kind of hover on it, you'll see the metrics. Anything over 80 is good, guys. Like fantastic. Anything 60 to 80 on the ROID is average. Anything under 60, you're just not getting the credit to justify anything here. And so I know I'm well over my minimum thresholds on what would be considered a great credit. That tells me I have credit to play with here. I'm willing to give up some of that credit to improve the standardized ATR buffer so that I don't have to make decisions. Guys, we do not want to make decisions in credit trades.
So then to illustrate what you would do here, you're saying, let's see if I can go a little further out of the money and get a little less credit, but a lower delta. Maybe my ATR buffer is a little better.
And what will happen based on you're selling a 5, you're basically adjusting it 5 points, right?
It's making us move quite a bit further out.
What's going to happen is you're going to get closer to 3 ATRs on the ranges, and you're going to give up a little bit of the credit. The question though is how much of that credit are you giving up? And you just got to fill out the data.
Well, let's do it. So I would be doing the 65 strike. It had a 9 delta.
9 delta.
I bought the 60, so still $5 wide. ATR buffer is 2.8. Net credit was 40 cents or $40. The buying power is going to be 460.
And again, to the individual that's new to trading, they look at, well, that's just 2.8 versus 2.0. Guys, that's close to 30% more range you're selling.
That's right.
Correct.
Yeah.
That's one additional day that the market could find support. That's one additional day could make or break this trade.
Right.
Okay.
Right.
So the question I have for you guys is this. Is giving up a little bit of that credit, right? We're not getting the 17%. Now we're just getting the 8.7%. But is giving up a little bit of that credit worth getting a better range? And that's just a question that can be answered personally.
Well, and that's exactly right. But what I love about doing it this way visually, and I think this really helps a lot of new traders. I've seen this. I've seen the light bulbs go on. When you list the same potential trade twice, and you map out different ways you can play it, it just forces you to examine, okay, what is my cushion? What is my credit? What are the trade-offs here? Because that's the thing about option trading, Tyler. If you want to increase the probability, you're going to decrease the credit, but you're going to improve your probability of winning by getting that better cushion like Matt's talking about. So if I was looking at these two spreads, the only way I'm taking the top one, by the way, is if the technicals are pure and I feel like it's as much of a delta trade as a theta trade. The second one's the better theta trade.
Well, and it would be a slam dunk if this was $50 on 450. All right. I mean, the reality is the only reason this puppy is yellow at 8.7, another 5-10 cents, and it would be a slam dunk.
Yeah. And to me, again, when you look at it, I just think too many times in credit trades, we make too many decisions over the money we're making, and we geek out on how much money we're getting from an ROI perspective in a short time frame, when that to me it's really not part of the equation for me.
Mm-hmm.
Am I getting number one, do I like the technical scenario? Am I in the zone of support where I feel very comfortable? Number two, even if I'm wrong, do I have a range to where I'm going to be right?
Sure.
Both of those are far more important to me than whatever the ROI you're getting. And I just feel like when we were young traders, not understanding a lot of how that was, I just feel like perhaps we didn't take it to the conclusion before we all started trading these things.
Yep.
It took me a little bit of time to figure that out. But from my perspective, the key metric here for me in credit trades, if the ROI is there, perfect. That will take care of itself. Mm-hmm. But you need the range. Mm-hmm. Ranges to me are vital.
Well, I agree 100%. And once you start getting a feel on how to pump this data in there, you can start to really paint these pictures and get clarity pretty quickly, actually. Which is where I always love to map out 4, 5, 6, 8, maybe even 10. If I'm sitting down for a research session, Tyler, I'm going to find a handful of stocks so I can compare them. And that's what we've done here as well. The next step here, we were going to look at a couple of different stocks and their comparisons. Anything last on Roblox before?
No, I just, the other thing I would do to help bridge the gap between the numbers and the chart is I like coming back in and then saying, okay, so I had 70 as my short strike. That was choice 1. 65 was choice 2, and you'll see the appeal of the 65 over the 70. I just think even more obvious here when you look at the chart, right? 65-60 looks like a pretty good little range there. You're at the low end of its trading range that preceded the breakout. You would feel a lot more comfortable with that than the 70-65.
Mm-hmm. Yeah, good point. Very good point. All right, let's take a look at those other two stocks if we can and kind of pump those numbers in. These are different types of volatility trades, obviously. I mean, Roblox is a newer company, recent IPO, recent earnings, moving a little bit faster. Schlumberger was one we were looking at, a little lower volatility, Tyler. So how would you build this one here?
Yeah, so it is a little bit lower volatility. Nice little bull retracement. A lot of energy stocks have decent pullback patterns. So I wanted to cross compare. And one thing you could look at, I don't know if the Roblox implied volatility for July is about 69%. In comparison, if you look at Schlumberger, its implied volatility is about 40%. So, it's got 2/3 the volatility of Roblox. And in fact, why don't we jump actually to Coca-Cola, which is about, I don't know, a quarter of the volatility. This will maybe make the example more extreme, and then depending on time, maybe we may or may not do Schlumberger. But let me actually jump to Coca-Cola, Tim, if that's okay. Mm-hmm. So Coca-Cola, same game here. Stock price 55. This is going to be a July 30-day option as well. Coca-Cola has a much smaller ATR for 2 reasons. 1, it's a cheaper stock. 2, it's a consumer staple stock, super boring. So 61 cents is what its ATR is. I mean, come on, it moves 1/10 the amount of Roblox, right? So, all right, what am I going to sell for a credit spread here? Well, I don't want to sell a 50 delta, I'll tell you that. So looks like I'm going to have to sell a 15 delta, and I'll round it up. So we'll call it a 16 delta. I'm going to sell that. That's the 52.50 strike, and then I'll buy the 50 strike. I would not do a $5 spread on this. I would only do a 2.5 wide. 11 cents. 11 cents on a $2.5 wide, which means my buying power is 239. So I can remember that. You might have to go back and forth, but I did a 52.50, 50 bull put. I had a 16 net delta. My credit was only 11. My risk was 239. Okay, so now you can see at the beginning here, looks pretty similar. 16 delta, 16 delta on Roblox. That's similar. ATR buffer is way better on Coca-Cola. So I was able to go really far out of the money. That part I like. I like that part of this particular trade. That's a positive takeaway. I'm all the way down at 52.50, which again, for a stock like Coca-Cola is way far away, right? Many ATRs, 4. The question though is, since I'm so far away, are they paying me enough money to still make it worth my while? 11 cents on a $239 cost is only a 4.6% return, which by credit spread standards is very low. That's why it's red, right? That's why it's red.
Mm-hmm.
And maybe if my delta was 5, that'd be okay, right? If I could sell a 5 delta and get almost a 5% return, that'd be a ROID of 100. Oh yeah, you're good.
Yeah, you're golden.
But the problem is the delta is pretty high for only getting the 4.5% return, which means the ROID sucks. Okay, it just sucks. So I suspect if I understood what Matt was saying earlier, Matt wouldn't take this trade.
No, again, the numbers kind of speak to me, and what you would do is you would be looking to actually be more aggressive with the delta you're selling. So the opposite conversation we're going to have on Coca-Cola in comparison to Roblox. Now, you are going to see a little bit of generalities here. One, Coca-Cola being a consumer staple stock, Roblox being an extremely aggressive growth stock. And so that's typical, right?
Yep.
When you match that. But at the same time, you can still look at the principle and learn from it. And so when I'm looking at an ATR 4.1, I love that. That's beautiful, right? And like Tyler, like you indicated, if you were getting that buffer with, say, you wouldn't even have to get a 5 delta. I mean, honestly, 10 delta might get the job done, right?
Yeah.
But you're just not getting the credit to justify it. And so what you would want to do is you would say, okay, let me play with that buffer a little bit, sell a higher delta strike price and see what that looks like from an ROI. The problem, it's Coca-Cola, and what are you going to do? Sell the 55.50 delta?
What you'd have to do is you'd have to go to one of the weeklies, which give you strikes between those two, right?
Yeah, but then you deal with liquidity issues on some of those weird strike price that are not traditional strike price differences, right?
Yep.
And so for me, it's like, it's Coca-Cola. It's much more of a naked put covered call type candidate than it is a bull put candidate. And so I like the example because the example does show you that on a stock like Coca-Cola, well, credit spreads in general, when you're dealing with low volatility, like people in general say, oh, the VIX is low, so everything's bad. No. What that means is you can't do a bull put spread on Coca-Cola. It means you can do a covered call on Coca-Cola. When people talk about low volatility, they don't understand how to adjust from a systematic perspective. Coca-Cola is a covered call naked put stock. It is not traditionally a credit trading stock. Roblox, nobody in their right mind would do a covered call on Roblox that has a 60% implied volatility. And so what happens with low volatility environments is things like Coca-Cola that you could have done a bull put spread on in higher volatility times. You can't do that. You got to look at covered calls there. On a stock like Roblox that most likely would have been too volatile to even touch, now you're looking at that as bull puts. And so it's a fascinating thing that I see with volatility. But yeah, the numbers do speak that you would try to sell a higher delta on Coca-Cola to see if you can massage that credit versus ATR buffer.
Agreed. And one of the things I love about the spreadsheet is it visually displays all of that information so that you can kind of understand it better. And who doesn't love the visuals, Matt? I mean, that's the whole thing about data. When you can take data and take it to an actionable step because you better understand something, that's value, in my opinion.
Well, and what I love about data-driven metrics like this is too many times we as traders get attached to certain symbols in the marketplace. Right? We like certain names. We don't like certain names. And we have an emotional attachment to that. When you just line up 30 potential credits on different timeframes, you're really just looking at numbers there. and it's the numbers. And I can't tell you how many times I went into research saying, I like Amazon, I like Apple, I like Microsoft. And all of a sudden I found this stock I didn't even know existed, right? You got to get to the point with credit trades where you let the numbers do the talking, because directional trades are I give the analogy of the market assassin, right? We're pinpoint with our directional systems. Credit trades are really about comfort level. They're really about the ATR zones that you're comfortable with. They're really about, are you getting paid enough credit to justify that type of zone? And so there is some more comfort in terms of where you're selling those strike prices. And so I feel like filling out the data, even though it can be tedious at times, once you get good at it, it's like anything else. It's pretty quick.
I agree.
Well, and you could do it in your head at some point. Like you start to understand that.
Yeah. Oh, finish your point, Ty.
Well, just as I've heard you, this was helpful for me because I don't know that I've heard you fully explain Royd in the setting I've been in, but you eventually start to discover what causes you to have a Royd of 100 or a Royd of 0.8, and you can start to put together and understand you can't sell 10 deltas and get a 1% return. The math doesn't work.
No, it doesn't work.
10%. And so for me, I was able to just pick up some of those connections to where it will become quicker as I do the numbers moving forward.
And personally, when I'm assessing credits, I never fill out the data either, guys. I do everything in my head. But when I'm looking at cross comparison, even today, I still fill out the spreadsheet.
Yeah. It's a valuable thing. If you're out there and you're watching,
I just like the visuals.
I love it. I actually love the spreadsheet. So, and I love teaching from it. I think it really helps.
And if you'll just give me 1 second, this spreadsheet was designed over years and years, right? And there was a lot of people, specifically Marius, one of our students, Marius, want to give him a shout out because one day he contacts Tim. He was a former student at Tim's. And one day, we're talking about these things and Marius like, hey, listen, I can help. And he was vital in putting this together for our community. So Marius, thank you so much for that, for your wonderful help in doing so. But also, I mean, these are the conversations we have with our community over years and years and years. And when you look at the spreadsheet, at the bottom, you'll see a couple different types of strategies here. Each theta system has a unique spreadsheet to it because the rules and the metrics are slightly different. And so for covered calls, you have a covered call. Short puts is your naked put. Bull puts, bear calls, iron condors would be the combination of the two credits. Short strangles, time spreads are your diagonal spreads, your horizontal, your diagonal. Tyler, you love your calendar spreads, right? That would be your more of your calendar spread type. And then at the bottom, you have some resource links. We will update these, but these are just some helpful things we've done over time to explain certain things.
Love it. Love it, guys. Yep. You can find those journals on the Trade Center tab over at Tackle Trading. Get the download if you have any questions.
And if anybody, hold on, sorry to interrupt, knows how to write a script from Thinkorswim to automate the journals, I would like to talk to you.
I would love to have that convo as well. All right, let's start wrapping up the show here, guys. 3 minutes here. We're going to get a Fed policy decision. The press conference not for another half an hour, though. That's really when the action starts, so to speak. That's what I'm going to be paying attention to.
When do you get the popcorn out?
I'll pop the popcorn after the policy statement comes out, just before Jerome Powell starts speaking.
Listen,
That's the popcorn.
I bought
moment.
a 14-pack of liquor, and every time the word transitory is used, I'm drinking. I may or may not be on Trade Masters tonight.
I would not recommend day drinking games over Fed monetary policies.
It's a bad plan.
But hey, listen,
recommendation.
Stop out of that immediately.
Yeah, stop out.
Stop out of that immediately. Marky, welcome in here. Obviously, you got Trade Masters tonight.
We got all kinds of stuff going on tonight at Tackle Trading. We got Trade Masters here on YouTube. 7 p.m. Eastern. We got Frank Martin versus Jake Lamore. I don't think they've ever matched off before. I'm very, very interested in that. Jake's confirmed. Then we got Trading Lounge at night. Greg Holmes at 8:30 Eastern. And then following that at 9:30 Eastern, we have Cash Flow Condors with Tyler Craig, which has been, so we got a full night of programming at Tackle Trading.
Busy Night of Programming, Trade Masters right here on YouTube. Do not miss that one. Then pro members, we got the lounge and then the Cash Flow Club after that.
Cash Flow Condors.
Cash Flow Condors after that. One last thing I did want to do here, Tyler. If you
Tyler,
can,
maybe you do some spreadsheet work tonight in Cash Flow Condors.
That'd be great.
I could. Yeah.
Use the condor on that spreadsheet. Tyler, can you bring up that Trading Labs page that I had mentioned earlier? And, guys, we talked about this on the podcast. We had our podcast on Monday. If you've not listened to it yet, we are announcing and we are releasing our new product called Trading Labs on next Monday, June 21st. Enrollment will start then. That's $49 for pro members. There's more detail on pricing to come in terms of annual packages and all that kind of stuff. But if you can scroll down, Tyler, I actually wanted to ask you a question about the teams a little bit here, just as we wrap up on the show.
You want to show those pictures?
I do. Team Tackle. Look at the visuals behind these teams, because we have 3 different teams that we're going to be launching. Coach Tyler's going to be running Team Phoenix, Coach Mark, Cashflow Vikings, and Queen M, Coach Emily Mururi, is going to be running the Dynasty Investors team. Tyler, talk a little bit about Team Phoenix, what it means to you, how you came to that, and what it's all about.
Yeah, as I'm talking about that, one thing I'll mention is we, as part of the Tackle today, over the last couple of days and probably the next few, we're discussing each team. So if you want a more in-depth, a little bit more in-depth, other than what I say today on how I feel about Team Phoenix, what was the motivation behind it, go read yesterday's Tackle today. Today was Mark with Cashflow Vikings. So I like the symbol of a phoenix. This was a fun exercise for us as coaches, coming up with our own names, coming up with symbols and logos and visuals. I've never done that before, so it was fun. It was fun. When you think about a phoenix, phoenix birds, they die and then they're born from the ashes, right? They're immortal. I just think there's a lot of parallels between that and trading, where we make mistakes, we have bad trades, and then we come back, right? We have to evolve as traders. We change over time. My methods have changed from when I started. And so I just really liked that representation, right? This phoenix bird of renewal, rebirth, coming back. I think that should resonate with any trader who's gone on this journey before. In terms of what we're going to focus on, trade management is a big thing. The tagline talks about, success being 90% trade management, maybe 10% trade selection. So going to be talking a lot about my favorite trade management techniques, mostly on credit spreads, scaling in and scaling out. That'll kind of be the focus.
Mm-hmm. Maddie, we are excited about this. We're going to start enrolling people next Monday, and we'll be talking about it probably each and every day until then. Anything you want to just kind of add to the Trading Labs conversation here as we wrap up our show on a Wednesday?
I'm excited. That's all. I'm just very, very excited for the community. I know kind of what's in store for Trading Labs, and I'm excited. Like I said on Monday, I'm excited to see how these teams evolve over time and the conversations they have, not just in the webinars that our community will have access to that embrace Trading Labs, but also just how those conversations naturally happen over time as we start using other technologies to increase the communication we have with our community. And so with each team, they'll have, private conversations in Discord and other access as well. It's not just the webinars, but what Mark's planning on doing with Cashflow Vikings and, Coach M with Dynasty Investors, and love what's happening with Tyler with Team Phoenix as well. We segmented them into teams. Again, Tackle Trading is the team. Tackle Trading, we're all part of the same team. These are just, the names are really signifying towards the individual coach and how they're approaching their specific trading lab, because it's going to be tailored to them as traders, right? Tyler's going to be talking about how he goes about the market. Same thing with Coach Mark, same thing with Coach M. And so, I'm just excited for it. It's something we've worked hard on the back end, and it's time to get those teams out there. So looking forward to it. Yeah. And honestly, I'm looking forward to coming in and just being part of it. Showing up and interrupting Tyler's lap. That would be fantastic.
I'm going to be a fly on the wall, no doubt about it, and interrupt several times. Come in and join the conversation, I should say.
But just Tyler's, never Queen M. Never Queen M.
She'll toss you right out of there. Didn't you have?
You kidding me? I'm not showing up.
Did you see Mark get his head lopped off yesterday in the Queen's Court?
I don't offend the Queen. I bow.
She's not messing with that. Initial price response here right after the Fed announcement. I'm digging through some of the policy statement. There's some stuff about the dot plot I'm looking at. Looks like the new dot plot's going to project a rate hike in 2023. That's the headline that came across the wire. But guys, I'm going to make this very simple. Until we get the press conference, until we get price action through the end of the day, until we see the overnight follow through, I am not going to get worked up about this myself. Tyler, but that first burst is to the downside. Anything you want to add into that real quick?
Give it 2 minutes.
Give it a few minutes. Give it a few minutes. This is kind of how it works, right? And the crazy thing is, it looks like a massive move because the market's been moving 0.25% a day and less than that, right? But in reality, you're talking about a 0.5% move. It's a nothing. I don't want to say it's a nothing burger because you are seeing an increase in volatility, but the point is you can't go off of the first knee-jerk reaction. You have to wait.
Yeah, you have to wait. Which I'm going to start that popcorn right now, Maddie. I think it's going to be a popcorn chart through the end of the day. We'll be watching that press conference
again. Very quickly, just on the Fed, and I'd like to dive into the Fed before I give any proper assessment here because I'm not going to do overreaction Wednesday off of 30 seconds of data. But the event we're talking about is an event. It's not a single number that comes into the market and immediately gets priced in through algorithms. It's not the labor market numbers. It's not the inflationary numbers. It's not the job numbers. It's not like that economic. What you get is an initial response to the statement. But what the important part is the commentary that J. Powell has after the statement. Remember, you have the statement, then you have the presser. It's the presser that's going to be important because I doubt they made any adjustments to monetary policy right now. So let's see where that additional commentary comes in with Jay Powell when he's asked those questions on, okay, now you're projecting 2023. What changed? How many Fed members changed? Remember, there were 7 of the 18, and that was an increase of 3 from the previous dot plot. And so we were anticipating more members of the Fed, given the recent data in inflation, projecting that 2023 interest rate hike. But let's see the numbers, let's hear the commentary, and then let's proceed with the analysis.
Yep.
And hot takes need to take a step back here. Let the data play out.
I think that's the wise approach here. And we're going to let that data play out, let the chart play itself out. And then we'll be back tomorrow here, guys, on this show, breaking all of it down. We'll let you know what we hear from Jerome Powell. And, I'm sure Matt will have a few takes on that, as well as anything we learned from the policy statement, all those kind of things. Guys, we're out for today's show. Have a wonderful rest of your Wednesday.
Love you, Tackle.
Love you guys the whole way. #Team Tackle always in the chat. We'll be back tomorrow, same time, same station.